So I wanted to take a very careful look at what is going on with the S&P 500, but more specifically, what is the typical earnings per share that we might expect from a typical company? So there's a couple key statistics that you should just know about the S&P 500 that may surprise you. One is that there's basically 500 companies, but of those, the 10 largest ones comprise about 20%. And remember, there's over 500 companies here, but only the 10 of them have 20% of the total value of the S&P 500. Now, the S&P top 100 companies have approximately 60% of the wealth. That means that the other 400 or so companies, so unbelievably, the remaining companies, 400 or so of the 500, um, have less than say 20% of that total wealth of the S&P 500. So this gives you some idea, right? However, the blue area, remember, is only about 10 of those 500 companies. All right. So you can kind of visualize that in a different way here. Let me see if I can do that. So here's kind of a graph, right? So you can see on the far left here, right? So the red line shows you the percentage of the total stocks, right? So you can see that that small percentage there is 20% of the wealth. The S&P 100, the next 100, is 60% of the wealth, and all the rest, there's a huge number of stocks there, but they have a very small percentage of the wealth. So bear with me, there's one final idea here that you need to understand. So there's a lot of these S&P indexes, right? There's S&P 500, which is about 50% of the total market value. So when I say total market value, that's all the possible stocks ever in infinity for the stock market, right? That's those 500 companies have 50% essentially of the total wealth. Now, if you take the other indices, because you have the S&P 400, which is kind of the mid cap, and then you have the small caps, the S&P 600s, and then you have the S&P 1500, which is kind of a combination of all the others, or the S&P 900. You can kind of see what that is relative to the whole market, right? So when you look at the S&P 1500, you're essentially looking at almost the entire stock market, with the exception of a few like very small companies, right? So, but there's maybe 5-10% of that. So again, this is looking at the whole stock market. That's like in the trillions and trillions of dollars, and then how the S&P relates to that full market. So I want to add one last indicator here. Right next, what I did is I popped in the S&P 100 next to S&P 500. So you can see that the S&P 100, which is those top 100 companies, is about 25% of the full market, right? So in some ways that's kind of unfair, right? 100 companies being essentially 25% of the total market value. So you're almost an S&P 500 expert. Now, here's the last crazy part of all this. So I circled in pink here the top 10. So this is just the 10 companies of the S&P 500 comprise about a little more than 10% of the total stock market. So that means 10 companies in America control about 10%, which is about 5% of the whole world's economy. Because if you think about it, if if the U.S. stock market is 50% of the world economy, that means that 10% would be 5. Anyway, so it's just blows your mind to think about this. But it's important to realize that studying the S&P 500 may actually really help. So sorry if this is a little complicated, but here's kind of like the pie chart, just another way to look at that whole breakdown of those other graphs in terms of percentages of the whole U.S. stock market. Hope it's helpful. So there are basically some indices that tell you about the broad market. One that you commonly hear is the S&P 500, but there's also another one called the S&P 1500. This graph here shows the S&P 1500. This is about 90% of all the stocks out there in terms of total value. So that's something like $30 trillion of total value within just the S&P 1500. So, before you totally freak out about this, remember that these 500 companies are about 500 of these, say, 3,000 total that are traded, right? So, it's actually quite a large percentage of everything, which is, almost the entire stock market. And then, for that matter, if it's almost the entire U.S. stock market, the U.S. stock market is about 50% of the total of the entire world. So this gives us a very good indicator for, essentially what's going on in the world of the stock market. So when I first got started trying to understand what the heck is going on in the stock market, I have always heard about this PE ratio, which essentially is the price of the stock. So how much you pay for it when you buy it or sell it, the value of it, and that can be compared to the earnings. So what you do is you divide the price, which is higher than the amount of earnings that they are making, and you divide that by their earnings, and then you get the PE ratio. This is a very important number because it basically tells you, if it's extremely high, you know that the price is probably too high. And if the PE ratio is low, or significantly below the average, then you can start to make a good buy decision because you know that at least the company is selling a lot of products relative to the price of the stock. So that's the price to earnings ratio. So before we go back to that last graph, I wanted to go to this one and kind of look at the details here. So this is the S&P 1500, right? So this is almost everything, including the S&P 500, right? So the interesting thing about this, you might notice, is that quite a lot of the total value is in information technology, healthcare, and financials. And those three sectors on the right there are about 50% of everything, right? So you might find that the price to earning ratio varies a lot depending on the sector and can be quite good for some sectors and not so good for other sectors or completely unbelievable. I'm very interested in stocks that have a good price to earnings ratio because then I know that they're selling something and they're doing what they're supposed to be doing as a business. So here is a graph of the S&P 500. And actually, the initial part of the S&P 500 is very interesting, right? You can see that it had not too many fluctuations until about the 1980s or 70s and so on. And then it really rocketed up to about 2001. So if that's in your time frame here of memory, 2001 was kind of a major crash for all this dot-com everything, right? That kind of lost a lot of value in the whole market here. One way that I kind of calculate this is that you can see the S&P on the right there is the total value of the S&P 500. You can make a kind of a quick statement by saying that every 1,000 points is basically $1 trillion, right? So the total value of the S&P, really roughly speaking, right, in like 2020 was about 20 trillion, but really that's just the S&P 500, right? So that's just something I just kind of figured out. But in general, you can also see there was a major housing crash in 2008, and then after that, things kind of again went up really skyrocketing, like unbelievable amount, right? And then now you have this kind of global virus problem in 2020. right? So, and that drop looks to be the fastest and most significant drop ever in the history of the S&P 500, you know, going back to the early 1900s. So it's hard to appreciate what that means because 100 years of time frame is, beyond anyone's, knowledge of what's going on in the stock market. But you can kind of try to use the data to understand what this all means. So that was a pretty detailed graph. Here's another graph that you can kind of see to get an idea of what the S&P 500 has been doing, and kind of see those same kind of curves and problems in the S&P 500. So it's really strange because for some reason it's difficult to get a graph for the S&P 1500 going back. I've looked several different places, but in general you can see that it looks, at least to me, it makes sense, but in some ways it's kind of surprising that the general problems that you've seen kind of disappear on this graph. But if you go back to 2001 and 2008 area, you'll probably see those problems. It just doesn't really show up here on this time frame. So this is one of the more surprising graphs. This kind of shows you all the world markets, and you can kind of compare the total size of each, right? You can see that the U.S. market is like way out of bounds in terms of importance. There is a lot of land area, but in general, if you combine the UK, the France, Switzerland, Germany market together, you kind of get a better picture for what's going on in Europe. You may find, different numbers, like the UK stock market is very large, say relative to the German market, but yet the German economy is larger than the UK economy. So there's some conflicts and questions, in this numbers system, even within the smaller categories, and certainly with, all these categories. So here is kind of because inflation can be significant within the context, you buy a candy bar, 10 years ago versus now, and it's like twice the cost, right? So, price is kind of difficult to measure, right? So, like, remember the original graph was showing something like, 20,000 for the top of the S&P 500, right? And this graph is showing 3,000 for the top. So with inflation adjustments, you're talking about a factor of like 7 or like 10 times wealth change just with that's just inflation, right? So that starts to paint a totally new picture for everything when you graph the S&P 500 or S&P 1500, or even when you try to look at price to earning ratio. Inflation, you have a lot. You might have a high price. That could be also inflation, and you can also have the amount of sales. Well, you're selling more, but there's still a lot more inflation. So, in general, this kind of gives you some idea of, how these downturns may have really been relative to each other. So, in general, what we're trying to do here is get an idea for what the price to earnings ratio is, or the price to sales ratio. So here's basically the specific details of price to sales ratio, right? So you basically take the total number of shares multiplied by the price, and you divide that by your total sales over the past 12 months, right? And it's very similar to the price to earnings. So if you look carefully at this calculation, it's slightly different than that last one. So basically, let's say your share price is $10, right? So you would take that divided by the amount of total earnings that the company makes for that $10, right? So you would have to calculate how how much money there is divided by all the outstanding shares, right? And that would give you the earnings per share, right? So, in a similar way, is this other idea called the earnings per share, right? So, in general, what you want to do is you take the total profit divided by the outstanding shares. So, it's very similar to the price to earning ratio. Now, the price to earning ratio, you can more easily search for that, or the earnings per share, but when you're looking for various ETFs, for some reason it usually shows up as price to earnings. So that means that that's the price, the share price divided by the earnings per share. So it's very similar to this earnings per share, except for earnings per share is the earnings the other way around, right? So let's just make sure we got this totally knocked down, right? So there's a lot of different formulas to calculate your profit, your net income, or just your income from whatever, right? So essentially what we're trying to do here for this earnings per share is that it's earnings divided by the total number of shares. So what you can do is, let's say the shares varies throughout that earning period. So like, remember, we're looking at the earnings over a year, but we're also looking at the number of shares over that year. So you kind of take the average of, or the weighted average of all the common shares out there. So you basically take your total earnings and divide that by the average of the number of shares, and that's basically a very simplified version of your earnings per share. So essentially what we're doing here is we're taking the price to earnings ratio now, right? So we just calculated what the earnings per share is, but you kind of saw what the problem was with that, because essentially the share price is built into that, right? So we have to basically take the the share price divided by the earnings per share, and then we get the PE ratio. So, if you remember that earnings per share calculation, it is the total profit divided by that weighted average of the number of shares, right? So, think about this for a second, right? So, let's say your profit, or let's say your number of shares, you have a million shares out there, and your profit is $1,000,000. So, a million over a million is one. So, that means you have the earnings per share of $1 for all those shares. So using that same example, we had a earnings per share of $1, right? So let's say that the share price was $300. So in essentially what's going on here is the share price divided by the earnings per share, that means the PE ratio is 300. So that's actually a very, very high PE ratio. So I'm really sorry if this is confusing, but it's super important. So think about it, right? You just paid $300 for a stock, right? But the earnings per share was one. So what happens is that if the price is too high and the earnings per share is low, that number, the PE ratio, also gets to be high, right? And that actually you don't want your PE ratio to be, you don't want the price to be high, right? You actually want the price to be low relative to the earnings. So if they're making a ton of money per share, all of a sudden the lower denominator, the earnings per share, gets to be large, right? And if the earnings per share is large, then you know if the earnings per share is large, they're making a lot of money per share, but you have to take the share price and do that relative. So this kind of scales it so that it's a price over earnings per share. So this is one of the more statistical and complex graphs that we will look at here. But we want to essentially, I want to nail down this PE ratio concept perfectly for everybody. So this looks at kind of different eras. I don't totally agree with these eras. Obviously, we need to see more recent time periods. But it kind of gives you an idea here where the PE ratio is high, which is bad. And in essence, when the PE ratio goes very, very high, you can see that it's inversely proportional, that your annual returns also goes down, right? If the PE ratio is low, that means the price is low, but the earnings are high, then all of a sudden, Well, their earnings are high, right? So the PE ratio is low, so they're going to be making more money. So in general, there's certain types of stock that and certain types of investments that certainly will be a lot better because they have low PE ratios. Some companies, for example, technology companies, have very high PE ratios. That means the price is very high, and they're actually not making that much money. So as a result, it's very questionable. So this is again here is the S&P 500, kind of zoomed in, but you also see this lower graph here. This is the volume, so you can kind of see, volume has steadily been increasing since about 2000. Some of that is because of online trading and algorithmic trading. In fact, probably 40% or more of the total stocks are now traded just by algorithms, right? So that changes a lot of really what's going on in the stock market. But you can see that around 2009, things got to be very crazy um, relative to even 2000, right, in the stock market. So some of that wasn't really experienced by the general public, but from the stock market's perspective, it definitely was, right? And then you see kind of just heavy volume ever since 2007 or so, or 2008. So that's kind of the total number of trades, just to give you some idea of what that means. So this is kind of a simplified graph, and you can kind of see in general what's been going on, year to year. So rather than month to month or week to week. So this is a really sweet graph because it overlays on the left the darker blue price to earnings ratio, and then the red line shows the interest rates, right? So you can kind of see, compare the interest to what's been going on with that. So, one thing to think about here is that, I try to be pretty careful about PE ratios. So this is for, the S&P 500, and you can see that it's kind of, around, yeah, I think the technical average is about 15. But if you look at this, it actually looks maybe 20, or even higher, much higher at some times. So, what that means is that, when this PE ratio gets to be extremely high, it means the price of the stocks are just ridiculous. And you can see that for the first time, what happened in around 2000, which is kind of one of those most historic moments, was that the price of the stocks were getting to be so high, and they weren't earning that much, right? So, and then that caused a huge crash, right? So we know that anytime we see stuff like that, getting above, 25, things start to be, back to 1901 and 1929, you can see, and even 1966, price of the stocks were getting to be very high, relative to how much each of the companies were making. Now you can see interest rates, this is for money that you get from the bank, have stayed around 10%. But then interest went way up in like around 1980s. So this graph is kind of hard to see, but it's basically from the Wikipedia page, and it's very detailed. It goes all the way back to 1881 for the S&P 500, right? And some of these numbers may be kind of speculative, right? So in general, what they're doing is kind of taking it, trailing over 10 years and over 12 months, right? So sometimes, certain pieces of data can become mixed up with this. So in general, the blue line should be more stable, and the black line should be faster going. So to kind of explain this in a little more detail here, right, is that essentially when you take the price of the stock and you divide that by the most recent 12 months, which is the black line, that's the price to earning ratio over the most recent 12 months. But you can also do that over 10 years, right? And see how the price, because sometimes 1 year might be better or worse than others, but if you take that over 10 years, you have basically the price to earnings over that 10-year period rather than just 1 year period, right? So you can see a lot of the volatility with the black line and more stability in terms of the earnings over time, right? So let's just look at a particular example here, right? So in this blue line, you can basically see that the price to earning, so the price was actually quite high and the earnings were quite low. And you might kind of expect that because if you think about it, 10 years ago, they were probably making less money, right, than they are today. So the price to earning for the recent 12 months, um, in general, they're probably making more. So then usually that black line should be higher, right? So in general, when that happens, what that means is that the company was doing better and then actually started doing worse, right? So if you think about it, what that means is that essentially when the black line is below the blue line, that means that they are currently making uh, more money per share, right? And yeah, so let's look at this from the other perspective, right? So here, what you have is you have in general a lot of lines where the black is above the lighter blue, right? Or even further down, kind of, black is above it, blue line sometimes, and then below, but in general it was above, right? So what does that mean? So in general, if the black line is the most recent 12 months and it's high, and it's above the blue line, if you think about that, that means that their earnings are not so good at that time. But the blue line is showing that their price was, so for 10 years ago, they were maybe a very good company, but something is happening recently, so their price to earnings is actually bad because when it's when the price is high and the earnings is low, then the black line goes up. So essentially what that means is that if you compare these two, you know that the recent months, it's basically saying that there's stability from before, but not recently, right? And you basically have to take the price to earnings ratio to compare that for different time frames. So to kind of close out everything, this is a graph here. Looks fairly simple and innocent, but it's actually for the entire United States economy, right? At least in terms of the stock market. And if this is true, the S&P 500 being about those 500 companies being 50% of the U.S. economy, what this means is that that's actually 50%. If you take that, if the U.S. economy is 50% of the world economy, you have to divide these numbers by 2, and then you get kind of the percentage of the world economy, which is a very interesting idea. Hope this helped you a lot. Sorry, I wanted to correct myself. So what I was trying to say here is that it that the U.S. stock market is about 50% of the total stock market economy, right? So, and in terms of world economy. So, but in terms of like the GDP, the United States is about 25%, 23 point something percent, right? But 25%. So you'd actually have to take these numbers, maybe divide by 4, to get, the percentage of the whole world economy. So in general, what you can see from this is that the United States over the years has kind of kept about 25% to 30%, say, of the world's global wealth. Now, a lot of this should be proportional to like land area and different things like that, right? But it's not. But in general, it gives you some basic idea. So if you're interested in the details per country, here's kind of like what Wikipedia says, and you can kind of get a percentage breakdown for even all the way down to like say Mexico, but it gives you a basic idea per country. So we're almost done here, but basically you want to kind of look at the percentage in terms of a pie, right? So here you can kind of get a look at that. So, however, the actual wealth should be kind of done geographically, and here's what the pie chart should look, well, does look like right now. Not necessarily should look like. Obviously, you can see Africa has got only 1% of the wealth, but certainly a lot more than that in terms of land. So, basically gives you a general idea. Hope it helps. Thanks. So to kind of conclude here, this is the stock market map, right? So we know that the United States has about 54.5%, say, of the total stock market in terms of globally, right? And you can kind of compare that to sizes. So the stock market and wealth, looking at these two maps, you can kind of see are very different. So to kind of conclude here, we can kind of say that there's obviously a vast gap of like maybe 25% of the wealth is kind of very shifting and not we're not even really sure to even maybe even 50% of that wealth, right? Or in cases like Africa, with 1% of the total wealth, there's maybe maybe it should be 20% of the total wealth, right? So there's just some really big questions left in terms of how to calculate everything. So to conclude, take a look at all the different ideas about the S&P 500, how it's kind of broken down into different like subcomponents and different versions of the S&P, all the way up to 1500. Thanks.